Diversification is one of the most important concepts when it comes to investing and is especially critical if you're a new investor. Today we're going to cover what diversification is and how you can use it to shield your money from potentially large losses. In a nutshell, diversification is basically a risk reduction strategy to avoid having all of your eggs in one basket. Instead of investing all your money in a single stock, diversification means you should instead have a large variety of investments in case one does poorly or crashes. However, just owning multiple different stocks doesn't mean you're practicing stock diversification. And that's because stocks don't always act independently from each other. Say for example, you own 3 stocks: Netflix, Apple, and Google. In this example, you might think you're diversified since you own shares of 3 different companies. But companies that are in the same industry are often affected by similar events, and therefore there's a higher likelihood that if something causes one of the stocks to crash, it might also pull the other ones in the industry down as well. A perfect example of this is the dot-com bubble in the early 2000s. In this instance, over the course of 2 years, the NASDAQ, which is basically a collection of 3,000 of the top technology stocks, fell by 75%, which means that for every dollar you had invested in the industry during this time, you probably lost 75 cents. If this was the only industry that you were invested in, it could have caused you some significant financial ruin. So what's the answer to an investor that wants to avoid being overly impacted by events like this? Diversification, and not just being diversified by owning a few different company stocks, but rather owning a wide variety of investments across industries. And while this might seem like it's a lot of work to accomplish, it's actually much easier than you'd think. And that's because there are simple investments that do this for you automatically, and they're called index funds. Index funds are basically a collection of stocks or bonds that tracks a major index. Many popular ones track the total US stock market, or the S&P 500, which are already very diversified in their holdings. Because of this, when you buy a share of one of these index funds, it's automatically diversifying you to all the companies that make up the index. And they are just as easy to buy as regular company stock. For perspective, the total US stock market has grown historically about 10% each year over the last century. At this rate, your investments would double in value every 7 years, which is why investment experts like Warren Buffett and Jack Bogle recommend index funds for investors who want a historically stable way to build wealth in a diversified manner. There are other ways to add diversification to your portfolio as well. In addition to holding index funds that diversify your stocks across industries, you can also invest in different assets as well. Real estate, like your home or rental property, can be another way to diversify your investments outside of the stock market. Similarly, some people invest in other assets like bonds, CDs, commodities, or precious metals to diversify their holdings further. All of these investments carry their own risks and rewards, so definitely do your own research before committing to some of these investments. Overall though, diversification is a key strategy that investors use to avoid the risks associated with being overly invested in certain stocks or industries. Please let me know in the comments below how you use diversification in your investing strategy, and please like this video and subscribe to the channel if you found this video useful. Thank you all so much for watching. I hope you're all having a wonderful day, and I'll see you in the next one. Bye!